You're staring at a 5-minute chart, watching the ticker blink. For an intraday trader, navigating the market means finding a statistical edge in a sea of thousands of microscopic choices. Right now, the price action is stalling. It's moving sideways, consolidating into a tight, quiet range where buyers and sellers are perfectly matched. To measure this, you apply an indicator known as Bollinger Bands. You notice the upper and lower boundaries are visibly squeezing together around the price. In technical trading, this compression is a classic signal that a burst of volatility is imminent. Then it happens. The price suddenly and violently pierces the upper band with a massive surge of upward momentum. The setup is complete. You execute a long position to ride the upward breakout you've been patiently waiting for. Every step you took matched the textbook rules of technical trading. The logic was sound, but the second your order falls, the buying volume evaporates. Instead of riding a wave higher, a massive red candle crashes straight down through the center line of your chart. You've been caught in a false breakout. Your stop loss triggers, locking in a rapid, unexpected loss. If you followed the rules exactly as written, why did the indicator fail so spectacularly right at the critical moment? The failure was baked into the math before you even clicked buy. It all comes down to a single default setting, hard-coded into your charting software, the number 20. To understand the glitch, we have to look at how Bollinger Bands actually work. They rely on a central moving average, a smoothed-out line of recent prices, flanked by two outer lines that track standard deviations, or extreme swings in volatility. When you load this tool on almost any modern trading platform, it defaults to looking back at the last 20 periods of data. The 20 lookback is a legacy of the 1980s floor trader, an era when analysts were manually plotting data to analyze macro-scale daily charts. The logic behind it is entirely practical. If you take a standard calendar month and subtract the weekends, you get exactly 20 trading days. The number 20 is a historical artifact. It was designed to measure exactly 1 month of daily market activity. Now, take that exact same tool and apply it to a fast-paced 5-minute intraday chart. Let's do the math. 20 periods multiplied by 5 minutes gives you exactly 100 minutes. You are now calculating extreme volatility deviations over a highly arbitrary 100-minute window. This timeframe mismatch hypersensitizes the indicator. By using a ruler built for months to measure minutes, the bands overreact to tiny micro-fluctuations instead of tracking true structural market shifts. What the bands flag as an extreme overextension is actually just routine, meaningless intraday noise. The breakout you traded was an illusion. The price didn't actually surge. The mathematical boundary you were using to measure it was just too tight for the environment. This chart details key technical indicators from a comprehensive academic review. Researchers have analyzed years of market data to test exactly where these tools succeed and where they fail. A critical factor in their findings is a concept known as the return horizon, the specific length of time an investor holds an asset. Quantitative analysis shows that technical strategies yield statistically significant results only when the tool's calculation is aligned with the specific timeframe of the trade. When an indicator is pulled from its native macro environment and forced onto a microchart without recalibration, its predictive accuracy degrades. These aren't plug-and-play cheat codes. A setting that captures a broad trend on a daily chart becomes highly unreliable on a minute-by-minute scale. To fix this, you have to physically recalibrate your look-back periods. If you're trading short-term intraday charts, your indicators need to be manually adjusted to reflect your actual holding period. By aligning your math with the true structural cycle of the asset you are trading, you expand the boundaries to filter out the noise of false breakouts. A true trading edge depends on executing a strategy with deliberate, calibrated intent.